Hello, everybody, and welcome back to Kilde in Conversation. We are here today with Radek, CEO and co-founder of Kilde. And today's question is focused a little bit on private credit in general. So when you are an investor, you have already now decided that private credit is something that will benefit your portfolio. Then you might ask yourself, where does Kilde sit within the private credit space? Radek, we'd love to hear your thoughts on that.
Thanks a lot, Johanna, having me again. This is a very interesting question, especially now when there's more and more private credit offerings out there in the market, and more retail investing platforms are also offering private credit through their distribution base. And mostly what they are offering, and that's probably what our investors will be encountered, those are US-based funds from very reputable firms like Apollo, KKR, BlackRock, Blackstones, those companies which invest into the US private credit. And that's probably what most people imagine the first when you say private credit. And the recent criticism and challenge with private credit was also related to those US investments, where we see that the private credit is taking a bigger share of financing and start to becoming systematically important. But secondly, more important for investor, is that the way how US private credit managers are negotiating the terms with their borrowers is on the variable rate basis. So it means there's a base rate, usually is a US Treasury rate, and they will add a spread to it. And given that at the moment the US Treasuries are relatively historically on a higher level than it used to be in the past 7-8 years, it looks attractive. And on average, what we have witnessed, that those kind of funds offer 10-11% return. But here comes the challenge. If the private investor expects the private credit to be like a truly uncorrelated asset class, to the extent it is, but you can see right away how dependent you are on the interest rate, because the interest rate is going to go down, and then immediately what will happen is that the underlying assets of these funds will also start making less money, and the overall returns will go down as well. At Kilde, we do it differently. We, with the borrowers, we work on the fixed return basis. So we fix at the moment, at the onset of each deal, we in absolute terms fix the interest rate, and the interest rate going to hold through the whole life cycle of that loan. And that way you will get more resilient investment product, not even correlated to the interest rate environment, which is now changing quite rapidly. So I think that would be the main difference at the moment. But I could talk for hours about it. This is really a fascinating topic to me.
One big point then from what I'm hearing is the fact that Kilde's bonds are bullet bonds and they give you a fixed return throughout the tenure of these loans, whereas a lot of specifically US private credit market offerings are floating. So it means that as interest rate move, then you also end up getting a return that looks a little bit like this, and hence you're more correlated to public markets than what you'd be with something that's truly fixed.
Yes, you are indirectly correlated to the public markets, like anyway, given the size of the private credit generally and their role in the economy in the US, and given that it is linked to the interest rates. So your conclusion is absolutely correct.
Perfect. All right. Thank you very much. And if you are an investor and have additional questions for us or for Radek, let us know in the comments and we'll be happy to answer. See you next time.
See you next time.